All right. Thank you everyone for joining us on today's webinar with National Bank Direct Brokerage and National Bank Investments, where we will talk about real assets and infrastructure and how you can get some exposure to that in your own portfolios. So today is a rather exciting webinar. I do have a fabulous guest speaker with me named Shadi, and he will be pretty much leading our discussion today. So we're super excited about that. And before I get into all the fun stuff, really, first, a nice little disclaimer. So the gist of it is just understand that you do have to do your own due diligence and research because ultimately National Bank Direct Brokerage is self-directed. So just keep that in mind. And before we get to really the fun part, Shadi, did you want to introduce yourself to everyone?
Yes, thank you very much, and hi everyone. Thank you for joining this webinar. So my name is Shadi Saya. I'm director at National Bank Investments. National Bank Investments is the manufacturer of mutual funds for National Bank of Canada. We offer a variety of products, fixed income, equity, and I work in the team that does manager selection and oversight. So National Bank is a fully open architecture, which allows us to choose the best asset managers in the world to manage our products. And I'm lucky to be part of the team that does the due diligence and selection of these different managers.
Perfect. All right, let's jump right into it.
Yes, thank you. So thanks again, Anne. So before getting into real asset, we can jump onto the next slide. Here's a bit of an overview of what we're going to discuss today. So bringing up really the topics, what's the asset class, what's the reason to have diversification in the portfolio, put some evidence behind all the qualitative aspects, and then moving on into how it fits in your portfolio and how you can access it. And then we'll give you an example as well within the platform. So jumping to the next slide, before getting into real assets, it's worth grounding the discussion in the basic principle most investors are familiar with, which is diversification. And here, this slide summarizes a bit the best practice for diversification. So first point, not all investments move the same way. And that's something that's very important. We've seen sometimes asset classes move together, sometimes not. But in general, most investments do not move in the same direction at the same time. Different asset types react differently to economic growth, interest rates, inflation, market stress, geopolitical uncertainty. So when a portfolio is concentrated in one asset class, one geography, one style, all its components can be exposed to the same risk at once. And diversification really helps to avoid relying on a single outcome. The second point is diversification improves the chance of capturing opportunities. Markets rotate, different sectors, different region, different asset classes, and assets perform well at different points in the economical cycle. A diversified portfolio increases the likelihood of being exposed to areas that are performing better instead of having returns depend on one narrow segment of the market. Quick example, you might have a lot of tech stocks or AI stocks, softwares. Well, this could be doing very well, and this tendency could change as well, right? Could move and shift depending of the different market circumstances. So it's important to be able to capture different opportunities. Third point is it helps manage risk and volatility, and this one is very key. Diversification helps manage risk and volatility. While it doesn't eliminate losses, combining investments that behave differently can help smooth portfolio ups and downs over time. For many investors, that smoother experience is just as important as long-term returns because it helps them stay invested during periods of uncertainty. And we've just passed a big period of uncertainty in the last few months, let's say. So for many investors, diversification often means holding stocks and bonds across regions. The next step is asking whether adding different types of assets can further diversify a portfolio, and that's where real assets come in. So if we look into the next slide and really getting into what real assets are. At a high level, real assets refer to physical, tangible assets that we rely on every day. Things like real estate, transportation, infrastructure such as toll roads, bridges, and airports, as well as utilities like energy grids and water system. These businesses are typically built around heavy, long-lived assets with low risk of obsolescence, meaning they are less likely to be disrupted compared to other sectors. They're less cyclical. They also tend to share a few important characteristics. First one being a high barrier to entry, given the capital required and regulatory constraints. It's not going to be very easy to build a new highway, to build a new bridge. It takes a lot of investments, which makes it more difficult to enter. Second point is stable and predictable cash flows, often supported by long-term contracts or regulations. So we're talking about electricity. Those are, you can see pattern. There's a regular usage of electricity. Sometimes you're going to have surges, you're going to have peaks, but that's something that's very regular and predictable. And the last one is essential service nature, which makes demand relatively inelastic across economic cycles. So you can think about your water usage, right? That's something that even if there's a downturn, you'll still need to use water on your day-to-day. So it makes these companies less and these assets less impacted by various economical cycle. What ultimately drives the value of listed real assets is fairly intuitive. It comes down to utilization, demand, and the scarcity of supply. In many cases, these are essential services with limited competition, which supports resilient earnings over time. Because of these characteristics, real assets tend to preserve value over the long term, often more effectively than more traditional asset classes, particularly in environments where stability, income, and inflation protection are key.
Perfect and really insightful. And I really like the breakdown of what exactly is real assets. I do have a question though, more so on I guess the asset allocation of real assets. So should real assets or infrastructure be considered part of the alternative investments or part of the equity portion?
It's a very good question. Listed real assets like infrastructure are technically they're stocks, right? So they often get lumped into the equity portion of an allocation, but they behave differently from typical equities, which is why some investors think of them as an alternative slice. They pay steady income, so more of a dividend compound, and respond well to real world usage like rentals, giving them more of a defensive, inflation resistant feel than growth stocks. So they're technically publicly traded equities. Many investors treat them as a hybrid part of their equity allocation, but with an alternative like benefit of diversification and stability.
Good to know and good to clear that up as well.
So, and if we move on to the next slide, so now that we kind of put together what real assets are, let's get into why invest in real assets. So we mentioned it a few times now, increased diversification. Returns drivers are different from regular stocks. Real assets value and cash flow come from a real world demand and usage, not just investor speculation, which we've had a lot of also in the recent times. Different return drivers also equal respond to different economic forces than stocks and bonds do. The second point is portfolios of resilience. So real assets are essential services with stable demand. So they better absorb economic shocks and periods of market stress. And they're what we consider, and that's some you might have heard that term in the last few months. They're halo assets. So heavy assets, low obsolescence companies. So companies that won't be disrupted by trends or development of new technologies massively. They're physical, low obsolescence, not going to be necessarily impacted by all of AI and whatnot, as their low obsolescence nature. The third point is exposure beyond traditional asset classes or traditional indices. Real assets give you access to a unique sectors and business model, like regulated utilities, transportation infrastructure, specialized real asset that often are unrepresented or absent from standard equity and bond indices. So giving that allocation, that exposure to asset classes that have usually less coverage or less interest at least, and represent a smaller weight in indices, with tech representing a big percentage of traditional asset class, over 30%, for example, in the S&P 500, while getting access to the other sectors is also something that's very interesting. An extra point that's not on the slide, but it's and that's something that's more recent, but it's actually also there's a trend capturing aspect to real assets. With the growth of AI, there's a massive surge in energy and infrastructure demand. So exposure to physical infrastructure needed for AI boom, talking here about power grids, pipelines, data networks, data centers, and it gives you access to that AI trade as while avoiding these speculative tech valuations that you might not see in those names that make a lot of the news. So the important trends in real asset can capture electrification, digitalization, and AI, energy transition, population and food demand. So that's something that's an extra reason why real assets are very important and have a good future in front of them. So if we move on to the next slide, now that we saw maybe a bit of the reason why we should invest from a pure investment asset class reason, let's put some numbers to it. And we can see here we're highlighting the correlation of infrastructure, real assets, to the traditional asset classes. So like previously said, real assets revenues comes from contracts, property usage, and regulated tariffs, not just market sentiment. So performance patterns diverge from typical stocks and bonds. And here we can see their hybrid characteristics. They offer equity-like growth when usage or rent rise, but also bond-like stability, long-term contracts, regulated terms, also the dividend aspect, which usually results in lower correlation to traditional assets. And why is that? Because they are often less sensitive to equity and bond market cycles, and because they provide an inflation linkage, which further differentiates them from traditional financial assets. Table highlights here the diversification benefits through correlation level. As expected, correlations tend to be high within the equity markets, and that's what we could see with either EM equities, US equities, but still at lower levels than what we could see with all the when you combine equities together. And real assets, particularly listed ones, generally behave more like equities than fixed income in tendency. This is what we see, but they still have a diversification, as we can see, with correlation closer to 0.7, 0.8, and an even more significant lower correlation with the fixed income, as you can see with the bonds, either high yield bonds or US bonds or commodities. So that diversification through the correlation is something that's very interesting as well. Here we really want to highlight how infrastructure behaves with market downturns and or when high inflation strikes. So we mentioned that its diversification benefits. Now let's highlight the real assets resilience profile. Real assets are particularly valuable in a portfolio during market corrections and the high inflation periods because they often preserve purchasing power in these environments. So you can see there's a resilience in recessions where many real assets provide vital services that people use regardless of the economy, halo businesses, as we discussed, housing, electricity, water transportation, etc. Demand for these tends to dip far less in downturns than more discretionary sectors or cyclical sectors. So when recession hits, or even economical downturn hits, the earnings of utilities or toll roads typically remain steadier, cushioning a portfolio. On the inflation side, real assets are an inflation pass-through. A key advantage in inflationary periods is pricing power. Pricing power, pricing power. Real asset businesses often have built-in inflation adjustments. So toll roads, for example, can raise tolls annually by CPI. Regulated utilities get rate hikes to cover higher cost. Landlords increase rents on multi-year leases. This means the revenues rise with inflation, helping preserve investors' purchasing power. Real world example, when inflation spiked recently, many infrastructure companies simply passed cost to customers, maintaining their margins. So once again, the nature, the necessity of these assets combined with their capacity to pass on inflation makes them very interesting in a higher inflation environment or when the market downturns, because those are services that we will continue to use at almost all costs.
And that's a great point. You bring up inflation with this. I feel like that's almost the one of the elephant in the rooms, or just
Yeah.
things that, or factors that people are concerned about, especially when they're trying to build and manage their own portfolio. So, speaking about real assets in particular, what are the underlying features or aspects of real assets that allow them to really perform differently in inflation times?
Yeah, that's a good question. And I would say it's really the pricing power. That's really what's important. And what's even more interesting is that it's not just pricing power that a company is going to add, it's built in within the contracts in most cases. So the pricing power is part of when there's it's multi-years contracts, right? As we mentioned. So it's included within the contracts that they will be able to increase by CPI, for example, the pricing. So, and that's something that's very essential and that governments usually allow because be, the government doesn't have any advantage, the regulator at least doesn't have any advantage of just squeezing in the margins for these companies as they offer essential services. So they need to make sure that they continue to have the right earnings or the right income in order to invest and to maintain these different investments. So let's take the example of toll roads. If you don't increase the price of the toll with CPI, well, the cost for repairs is going to increase by CPI, and you won't be able to do these investments, and then the roads are going to go and become obsolete. And there's no one that benefits from that, neither the user, nor the government, nor the company. So all these built-in pricing power and inflation linkage is really what diversifies and what allows this asset class, real assets, to be a diversifier compared to the other companies, which are usually more consumer linked. And if there's a company, let's say, of a certain cookies or drinks or whatever, if they increase the price too much, well, you could go into another, you could change brand easily, right? Go for the cheaper option. You don't have that option within real assets, so it makes them more steadier income and long-term, more stable revenues.
Great analogy. I really like that one.
So if you move into the next slide and really discussing now the yield segment of listed real assets, that's something that's very important. The income profile of real asset is another element that really diversifies it and makes it an interesting investment. They typically offer higher yields than traditional equities, often in the 3 or 4% range, if not more. And that's more than the broad equity indices that are usually closer to 2. So right away, you're adding a meaningful income component to the portfolio. That's mainly because these companies generate, as we mentioned, stable, contract-based cash flows, things like rent, tolls, etc. So which allows them to consistently return capital to shareholders. As they're able to predict their income, they can return it to shareholders. They can also have a commercial real estate, where tenants have very long-term contracts. We're talking about 15, 20, 25-year leases. This enables the management companies to produce stable cash flows and direct most of it to investors via dividends or income. And importantly, that income tends to be resilient through market cycles. With long-term contract and high visibility on cash flows, these companies are generally able to maintain dividends even in more challenging environments where other companies might tend to cut dividend. For example, in lower rate environments, when bond or saving yields were near zero, real assets provided, it feels a long time ago when I'm saying this, but real assets provided a meaningful income alternative. So overall, real assets provide a reliable and diversified source of income, complementing what you typically get from equities and fixed income.
And I've noticed that a lot of these infrastructure ETFs or mutual funds, they hold a lot of global holdings. Is there a reason why?
Yeah, well, and you could see it here, right? Even in that chart, you can see it's really global real estate or infrastructure. It's really a focus on the globe. It's a very good observation. So we invest globally in infrastructure because assets and opportunities are spread worldwide, and global approach reduces the risk, right? No single country has all the best toll roads, ports, or utilities. So holding global assets lets us capture top-notch projects wherever they are. Like toll road operators in Australia, airports in Europe, pipelines in North America. It also means we'll avoid relying on one country's economy or regulation. That's something that's very important in that asset class. For example, if one region hits a rough patch or changes its policies, our other global holdings, sorry, can balance it out. We also diversify currency exposure and economic cycles, adding another layer of risk management. And I'll give you another example. You've probably seen it in the news. So Europe recently added an extra fee on airports in Europe. So the attraction for European investment in airports decreased, while you're not necessarily impacted because you're not only investing in European stocks. You have also an emerging market in Mexico, for example. You have some airports there in the Philippines or whatnot. So the impact of regulation is lowered, and you have more diversified, less impact from the economy or the economic cycle across the world. So I think we can go to the next slide, maybe do a recap on how real assets fit in the modern portfolio. First, it's important to understand that real assets are meant to complement equities and bonds, not replace them. You can think of them as the third pillar in the portfolio. What makes them interesting is that their returns come from real-world usage, things like people consuming energy, using infrastructure, or paying for essential services. So instead of doing the same thing as stocks and bonds, they bring a different source of return, adding a new dimension to the portfolio. Second, real assets play a key role in diversification and resilience. They reduce reliance on any single market, and they tend to behave differently from traditional asset classes, as we've highlighted earlier. Because of their low correlation, their role in providing essential services, and their link to inflation, they help make portfolios more balanced and more stable over time. Third, real assets should really be viewed as long-term strategic allocation. These are typically long-life assets with stable and predictable cash flow. So the benefits we just discussed, diversification, resilience, income, tend to materialize over time, not through short-term trading. That's why institutional investors have been allocating to real assets for decades, and increasingly, individual investors can adopt the same long-term mindset. So when you're seeing your tech stocks really fluctuating and jumping, let's say rallying in certain moments, your real asset investment will do steady growth across time and perform as well. So to put into perspective, so we always try to compare what the best practices are with our peers and the different big players in the industry. So JP Morgan did a research recently showing that the advantage of having an allocation to what we'd call alternative or less correlated diversifying asset classes, such as real asset. And you see that risk-adjusted return really by putting a 5, even 10% segment of your portfolio in alternative or diversifying strategies, while it really increases your risk-adjusted return on the long term. And moving on to the next slide, I think that's a key element also that a lot of you might be asking yourself right now is, well, how can we actually access this? How can we actually enter into the real assets market? So there's really 3 pillars. The first one, listed funds and ETF. So they provide instant diversification in a single investment, right? As you get a lot of different companies within those funds or ETFs, then benefit from an experienced management team, the benefits of active management in an asset class that's a bit more niche and has, it's, as we've mentioned a few times now during the presentation, they have their own reality, right? And it's also a more liquid vehicle, and it's the best to capture long-term structural trends. The second option is individual securities. So this is a more of a targeted exposure. There's no diversification. So if you have a portfolio, you can buy one, two, maybe three stocks. But as we mentioned, there's a lot of different subsectors within real assets. We're talking about toll roads, airports. We could talk also about utilities, REITs. So you're being able to buy one or two of these stocks. You won't have, it's going to be more targeted, less or almost no diversification. It requires also a lot more research and monitoring, as I mentioned, because they have a different reality coming from regulatory perspective and different geographies usually. So it requires more work, and the returns are driven by company-specific risk compared to a full sector risk. Lastly is what are private investments. So those are usually restricted to institutional or accredited investors only. And they have long lockup periods, many years. Usually you could talk to 5, 6, 7, 8 years. So there's no liquidity in them. And they have limited transparency in their disclosure.
Good points. And I know you're mentioning this, but what's the difference between real assets and listed real assets, and
Mhm.
how do the returns on these two differ over time?
Yeah, that's a very good question, especially regarding the returns, right? Because there's always the idea of a liquidity premium on the long term. So real assets usually mean direct ownership of physical assets, right? A listed infrastructure stocks gets revalued every second on the market, as we know. So your full transparency and short-term volatility comes together, right? Its price can swing with market sentiment or interest rates. In contrast, the private investments, which is what we would think, as I mentioned, when discussing real assets, is appraised only occasionally, usually quarterly. So its value looks steady and smooth over time, but less transparent on a day-to-day. So one is mark to market on a daily basis. The other one is going to smooth out the returns on a quarterly basis. But it doesn't mean that there's difference in the fundamentals. Despite the different short-term run volatility, both are driven by the same underlying economics. So on the long term, the returns often trend similarly. They have the same tendency, and they show to have the same long-term returns around, and I think we showed it earlier, around 8% annualized return. And it's the same targets usually in private real estate investments. Difference that listed real assets give you more flexibility with a bumpier ride, so that you can see them on the market, but they give you more liquidity. And over time, they'll derive value from the underlying. They still derive value from the underlying assets the same way that you see in privates. So it's really a question of the ride, but the access to liquidity that you have in one and not in the other.
That makes sense.
So if we go to the next slide, maybe just highlighting one of the products that we offer on our shelf at National Bank Investments, which is the NBI Global Real Assets Income ETF. So as we mentioned, National Bank is an open architecture, so all of our products are managed externally. This product is managed by Nuveen, which is one of the biggest asset manager in real assets in the world. Nuveen was founded in 1898. They manage over $2 trillion in AUM. So one of the biggest players, both in private and in public. So they have the expertise across all the segment of the market. It's managed by the portfolio manager, Noah Hauser, has 17 years of experience, and he has thorough co-portfolio managers with him, and a team of 11 members, which has an average experience of 23 years. That's a lot of experience for that asset class. And the really how they differentiate themselves in that asset class is the long-term horizon, bottom-up stock selection, focusing on three main characteristics: tangible assets, stable and predictable cash flows, and limited capital expenditures. So you don't want companies that take on too much debt, and you want to make sure that they hold tangible assets. Those are the key, and with regular cash flows. They target a beta slightly under one compared to the traditional equities, excluding highly cyclical companies or lower beta firms. So they really try to stay in the middle. And what really, because there's a lot of different products in the industry, right? What really differentiates them is their broader definition of what real assets are. So they'll include, for example, waste management, which is, one can argue, a utility. It's something that we all need, that's recurring. That's not part of the traditional or the index definition of what real assets are. To include waste management, infrastructure technology such as communication towers and data centers. And in the environment we're in, this is a very something they're really able to benefit, adding a lot of value and able to capture the AI trend. And they do risk mitigation or risk management through diversification across geographies and stocks. So they try to aim for 50 to 150 stocks. They're currently at 76, right in the middle. So you can see that it's a lot of stocks, it's a lot of diversification, which is hard for everyone to follow, right? If you want to have an investment in that asset class, with a dividend yield of 3.2, which is higher than the broader market, and they're invested in 13 different countries, 12 different real asset sectors, and some of their biggest allocations are electric utilities, so all of the power grid, especially in the US. We're talking about geographical diversification, mainly in the US, so that they can benefit from all the data centers and the AI power grid need. They also have an important allocation to pipelines. That's a bit more in Canada, right, but also in the US. Pipelines, also the need for more energy, as we all know. Airports, mainly in emerging markets where they see more flexibility as well. But they also have access to renewable energy, ports. They also have tech infrastructure, thinking about the data centers. So across a lot of the themes that we're hearing in the news recently. And they've shown long-term performance on the first quartile over 3 and 5 year horizons, while outperforming the benchmark, the S&P Global Infrastructure, on all these periods. And very quickly, some of the names you might recognize a few. So they own Next Era Energy. So they power a lot of the AI economy, a lot of the power grid. Also in the US, they own Enbridge, a local Canadian company that we all know, right? More on the pipeline, the need for more gas, especially going for more energy going into the US as well. They'll own a company called Digital Reality, which builds a lot of data infrastructure, data centers, mainly in Virginia, but also in Texas. So capturing all of that AI trade. American Tower, a lot of the towers for wireless carriers, also very interesting. So a lot of names that might sound familiar, all benefiting from the recent trends that we're seeing with long-term, all the benefits that we spoke about real assets.
Very insightful, Shadi. It's a lot to take in, but a lot of really valuable information. And it's really, I guess, another type of asset to add to your portfolio to really diversify it. So how to actually go about doing that in your own accounts at National Bank Direct Brokerage. So what I'll do is I will share a quick little demo on how to go about that. And we can start off on nbdb.ca. So if you have your own accounts, feel free to log in. And once you're here, you have a quick overview of your own accounts. This is a demo account. Now, if you're looking for and ETF tools, really, in particular, you can take a look under the Markets tab. This is where you'll find all of our tools, whether it's for stocks, mutual funds, options, ETFs. Since we're speaking about real asset ETFs today, take a look at our ETF Center. Here you'll find an ETF screener, a comparison tool where you can compare up to 4 different ETFs. right over here. But what I do want to highlight is the research section for ETFs. So you can find that under the ETF research tab, or you can also head on over to research, click on publications, and if you scroll just a bit, when you click on ETF research and strategy, you should be able to see just a list of all of our ETF research provided by uh, our capital markets team at National Bank Financial. And there is a particular list that I want to highlight. You'll find it under the Exchange Traded Funds Canada and US list. Once you click on it, it does look something like this. And this is where you can find all of the Canadian and US ETFs that are listed. They are sorted by different categories on the topic of real assets. You could do a quick control find. You can start off with some keywords like real estate, and it does showcase quite a few ETFs here. But also, if you wanted to learn a little bit more about an REA, take a look at the quote section, and you can either type in the name of the ETF or the ticker symbol just to get some more information on particularly the NBI Global Real Asset Income Fund. And with that, let me just hop on over to the PowerPoint for any closing thoughts.
Yeah, so I think in the what I would say is that in this environment where you've seen a lot of volatility, where you've seen a lot of uncertainty, questions about inflation, questions about where the economy is going, what's going to happen with tech, am I overpaying for certain stocks, value or valuations too high, too low? The importance of diversifying strategies is more and more important. And you don't need to get performance into lower return, single digit return alternative strategies. You could get equity like long-term returns, but with more protection, capital protection, and lower correlation through global real assets. And I think that's something that's more and more important, especially that now you're able also to capture all these AI trends in a more diversified ways. And I believe that our global real asset income ETF is a great way to get that exposure, and that asset class should be part of the allocation of all DIY investors.
Thank you, Shadi. And just to close us off, we do have a few interesting questions if you can shed some light on them. More so in particular on the NBI fund.
Mhm.
How does NREA manage risk and avoid being too cyclical? So what
Mhm.
does the portfolio team do to keep the strategy more defensive over time?
Yeah, it's a mix. I would say it's a mix of structural discipline and ongoing risk management. Goes both ways. At a high level, the strategy usually excludes highly cyclical companies from the start. So the PM focuses instead on essential service sectors. Doesn't need necessarily to go run after the current trend. Again, regulated utilities, pipeline, toll roads, I've mentioned a few of those names. These businesses tend to generate more stable cash flows and exhibit lower volatility over time. One of the ways also this pans out is the manager, for example, is underweight airports compared to the benchmark. In the benchmark, it's going to represent 25% of the allocation. We're at 10%. So that's one way of getting less exposure to those more cyclical names that you could find in the index by managing that risk. And then from the stock selection perspective, again, we've mentioned tangible assets, stable and predictable cash flows, and limited capex. Those are something that we mentioned earlier. So by focusing on these income generating, high quality names, the strategy aims to ensure it's not overly tied to economic cycles. Add to that the diversification through sectors as well. So you have the selection of stocks, the stock selection itself, where you have a layer of risk management, and add on top of that the portfolio construction from a sector perspective as well as from a geographical perspective. So 12 sectors, 13 countries, making sure that you don't have any inherent risk in your portfolios and ensure that there's diversification. Add to that all the layer also from a compliance and risk management metrics that Nuveen as a firm implements over all of its investment teams, including this one.
Thank you for that. And I do have another interesting question here. And earlier on, you mentioned data centers. So, talking about, I guess, trending types of infrastructure like
Mhm.
nuclear energy or
Yeah,
high performance computing infrastructure, can real assets provide access to those trends?
of course, it's very key actually to all of the real assets allocation. The real assets provide access to these teams through infrastructure that support them mainly, rather than through pure play exposure to the commodity, right? And that's something that's very important. We saw that with the energy and the pipelines, for example. So you don't need to buy the commodity to get that exposure. You can get it through the companies that you support that build the infrastructure in order to use them, whether it's nuclear energy, right? That or AI high performance computing. These trends rely on physical capital intensive assets, right? We've mentioned that a lot. So those assets tend to have long-term contracts and high barriers to entry that you might not have necessarily on the when you try to play on the commodity itself, right? Where you're playing a bit more speculation. And because those infrastructure that are used for all these investments, well, they are real assets, so they offer the same characteristics, long-term dividend payer that align with real assets. So instead of investing directly into more volatile, growth-oriented exposure through the commodity, you can play it through real assets directly. So also, if I take the example of the NREA, our ETF, so as pure play exposure to nuclear, you're talking about 1.5%, which is higher than the benchmark. But you also get, and this is where the expertise comes from the active management segment. If you look at the utilities that have an allocation or that use that power the grids that use nuclear as energy, you're talking about 20% allocation with names like NextEra, Entergy, Excel that have nuclear part of their energy mix. So that's also something that's very interesting, and you don't get that knowledge on the first glance. You really need to do the deep research to know how much nuclear exposure they have. And on the AI and data center side, the exposure comes through electric utilities and power networks, as well as data centers directly. Um, so either what's powering the data centers or the data centers themselves. And so all of the infrastructure is really where you're going to benefit. And also, it's a part of the NREA Global Real Asset Income ETF allocation.
Good to know. And one last question, Shadi. I know throughout the presentation you mentioned that long-term results have been quite positive for real assets, but there's not much return history for NREA in particular. So how do I find out more?
Yeah, so we've done some restructuring within the ETF in the last, so kind of lost the track record. However, there's the mutual fund that still exists, which has the track record to give you an idea. So the code is NBC 3799, sorry, NBC 3799. So if you look at the performance of that fund, management fees are MER is very similar. You're able to compare and see those long-term returns that I was mentioning at the beginning of well during the presentation earlier. But it's still with very similar performance as that product, so you can do that comparison.
Perfect. Well, thank you for answering all of our questions and for all your insights today. I know I learned a lot, and I'm sure all the viewers who will be watching this webinar will learn a little bit more about the real assets and infrastructure and how to effectively add that to their own portfolios. So thank you again, Shadi, for joining us, and hope to see all of you on the next webinar. Thanks again. Take care.
Thank you.